Stocks. You hear about them everywhere. On the news. From that one friend who won't stop talking about their portfolio. From your parents who say you should invest for the future, but never explain how. And yet, most people have no idea how stocks actually work. Not really. They know it has something to do with buying and selling. They know prices go up and down. And they know some people make a lot of money from them. And some people lose it all. But what is a stock? How do you make money from one? And is it actually safe for a regular person to invest in them? In the next few minutes, I'm going to explain everything. Simply, clearly, no jargon, no fluff. By the end of this video, stocks will make complete sense to you. Let's go. Here's exactly what we're covering today. 1. What a stock actually is in plain English. 2. How the stock market works. 3. How you actually make money from stocks. 4. Why stock prices go up and down. 5. The different types of stocks you should know. 6. How to get started as a complete beginner. Just the fundamentals, explained so clearly. Let's start. 1. What is a stock? Imagine your friend starts a pizza shop. It's doing well, but he wants to open 10 more locations. The problem? He doesn't have enough money. So he comes to you and says, "Give me $10,000. In return, I'll give you 10% ownership of my entire business." You agree. Now you own 10% of that pizza business. If the business grows and becomes worth $200,000, your 10% is now worth $20,000. You doubled your money without making a single pizza. That's exactly what a stock is. When a big company like Apple, Tesla, or Nike needs to raise money to grow, they don't just go to one person. They split the company into millions of tiny pieces called shares and sell those pieces to the public. Each share you buy equals a tiny slice of ownership in that company. You become a part owner, a shareholder. And as the company grows and becomes more valuable, so does your slice. That's it. That's what a stock is. Ownership in a company, broken into tiny affordable pieces that anyone can buy. 2. How the stock market works. So now you'd own a share of a company. But what if you want to sell it later? Or what if someone else wants to buy more? That's where the stock market comes in. Think of the stocks market like a giant marketplace, like eBay or a farmer's market. Except instead of selling clothes or vegetables, people are buying and selling ownership pieces of companies. In the United States, the two biggest marketplaces are the New York Stock Exchange, the NYSE, and the NASDAQ. These are where thousands of companies are listed and traded every single day. When the market is open, Monday through Friday, 9:30 a.m. to 4 p.m. Eastern Time, millions of buyers and sellers are constantly trading shares back and forth. And here's the key thing to understand. You don't have to go to Wall Street to participate. You don't need a broker in a suit on a trading floor. Today, anyone with a smartphone can open a brokerage account. Apps like Fidelity, Charles Schwab, or others deposit money and buy shares of almost any company in the world within minutes. The stock market is more accessible today than it has ever been in history. The barrier to entry is basically zero. 3. How you actually make money from stocks. This is the part everyone wants to know. How does owning a stock actually put money in your pocket? There are 2 ways. Way number 1, price appreciation. You buy a share of a company for $100. The company grows, performs well, becomes more valuable. Now that same share is worth $150. You sell it. You just made $50 profit. That's called capital gains, and it's the most well-known way to make money in stocks. The goal is simple: buy low, sell high. Though, as we'll discuss, timing the market is much harder than it sounds, which is why most experts recommend a different approach. Way number 2, dividends. Some companies, especially large, established ones, share a portion of their profits directly with shareholders on a regular basis. These payments are called dividends. For example, if you own 100 shares of a company and they pay a $1 dividend per share every quarter, you receive $100 every 3 months just for holding those shares. You didn't sell anything. You didn't do anything. The money just shows up. Many long-term investors reinvest their dividends, using that payment to buy even more shares. Over time, this creates a snowball effect that dramatically accelerates wealth building. So to summarize, stocks make you money through growth in value, through dividends, or through both at the same time. 4. Why stock prices go up and down. This is the question that confuses most beginners. Why does a stock price change every single second? Who decides what it's worth? The short answer, supply and demand, combined with human emotion. At any given moment, there are people who want to buy a stock and people who want to sell it. The price is basically the point where buyers and sellers agree to make a deal. When more people want to buy than sell, prices go up. When more people want to sell than buy, prices go down. But what drives those decisions? A few key things. Company performance. If a company reports strong earnings, more profit, more revenue, more growth, investors get excited and want to buy. Price goes up. If results disappoint, people sell. Price drops. News and world events. A pandemic. An interest rate hike. A new government regulation. A CEO scandal. All of these can send stock prices moving dramatically, sometimes within seconds of a headline breaking. Investor sentiment. This is just a fancy word for how people feel about the market. Sometimes fear drives mass selling even when nothing fundamental has changed. Sometimes excitement drives buying beyond what's rational. Markets are driven by humans, and humans are emotional. This is why stock prices can seem chaotic in the short term. Day by day, they're unpredictable. But zoom out over 10, 20, 30 years, the overall market has always trended upward. Always. That long-term perspective is what separates successful investors from people who panic and lose money. 5. Types of stocks you should know. Not all stocks are the same. Here are the most important types every beginner should understand. Growth stocks. These are companies that are growing fast and reinvesting all their profits back into the business. They usually don't pay dividends. Think early-stage tech companies. The potential upside is huge, but so is the risk. These can rise dramatically and fall dramatically. Dividend stocks. These are typically large, stable, established companies that consistently pay shareholders a portion of their profits. Think utilities, consumer goods, healthcare giants. Lower growth potential but more predictable and steady income. Great for long-term wealth building and eventually passive income. Index funds and ETFs. Technically, these aren't individual stocks, but every beginner needs to know about them. An index fund bundles hundreds or thousands of stocks together into one investment. When you buy one share of an S&P 500 index fund, you instantly own a tiny piece of 500 of the biggest companies in America. This is what most financial experts, including Warren Buffett himself, recommend for the average investor. It's diversified, low cost, and historically has returned around 10% per year. Instead of betting on one company being successful, you're betting on the entire economy growing over time, which historically it always has. Penny stocks. These are very cheap stocks, sometimes just cents per share, from very small or struggling companies. They're extremely risky, highly manipulated, and most beginners who chase them lose money. Avoid these until you deeply understand what you're doing. 6. How to get started as a complete beginner. Alright, you understand what stocks are, how they work, and how money is made. Now what do you actually do? Here's a simple beginner roadmap. Step 1. Get your finances in order first. Before you invest a single dollar in stocks, make sure you have an emergency fund in place. At least 3 months of expenses saved. Investing money you might need next month is a recipe for selling at the worst possible time. Step 2. Open a brokerage account. You need an account to buy stocks. Look for ones with no account minimums and no trading fees. Many reputable platforms exist. Do a quick search for the best options available in your country. Most take about 10 minutes to set up. Step 3. Start with index funds. Forget trying to pick individual stocks as a beginner. Start with a broad market index fund. Low fees. Instant diversification. Proven long-term track record. This is where the majority of your investment money should live, especially early on. Step 4. Invest consistently. Set up automatic monthly contributions, even if it's just $25 or $50. This strategy is called dollar cost averaging. You buy more shares when prices are low and fewer when prices are high, automatically smoothing out your risk over time. Step 5. Leave it alone. This is the hardest part. When the market drops, and it will drop, do not panic sell. Every major market crash in history has been followed by a full recovery and new all-time highs. The people who lost money in crashes were the ones who sold in panic. The people who stayed the course, or even bought more, came out ahead every single time. Patience is your most powerful investing tool. Let's recap everything we covered today. A stock is simply ownership in a company. The stock market is the marketplace where those ownership pieces are bought and sold. You make money through price growth and dividends. Prices move based on supply, demand, company performance, and human emotion. And the smartest starting point for almost any beginner is a simple, low-cost index fund, invested in consistently over a long period of time. That's it. Stocks fully explained. The truth is, building wealth through stocks isn't complicated. It's not reserved for Wall Street insiders or finance geniuses. It just requires understanding the basics, starting early, staying consistent, and having the patience to let time do the heavy lifting. You now know more about stocks than the majority of people walking around today. The next step is yours. If this video helped you, hit that like button and subscribe. We break down money and investing every single week in a way that actually makes sense for real people. Drop a comment. What confused you most about stocks before watching this? I'd love to know. See you in the next one.